To all of the witnesses for agreeing to appear before the subcommittee today. Today's hearing will examine the current state of the U.S. lending system with a specific focus on a case study involving the bank holding company FPOB and its affiliated banks, including Park National Bank of Chicago. The subcommittee has asked our witnesses to address not only the specifics of the case study, but also the overall picture of the health of the lending industry, as well as the process of how insolvent financial institutions are resolved. Because of the interest of members in this issue, I will be increasing opening statements to 12 minutes per side with the ranking member's agreement, but without objection, the record will be held open for all members' opening statements to be made part of the record. In addition, I ask unanimous consent that Congressman Davis, Congressman Rush, and Congresswoman Biggert and others be impaneled for this hearing, and that they be allowed 5 minutes each to question the panelists after the members of the committee. Hearing no objections so ordered, I yield myself 5 minutes. Ever since the beginning of this financial crisis in 2008, we have all heard about the big financial firms and the banks that have failed: Bear Stearns, Lehman Brothers, Merrill Lynch. But for every large bank that fails, there have been dozens of smaller to community banks that have also failed. Banks with names like People's First Community Bank, St. Stephen's State Bank, and even banks like Park National Bank that was supported by a largely successful holding company fail every week. While the focus of this hearing will be the failure of one particular bank holding company, it is my intention to shed light on lessons learned from recent bank failures and the insolvent bank resolution process. Last year alone, 140 banks failed across this nation. And so far this year, 4 banks have failed, including 3 just last Friday. Through this hearing, I hope to provide our banks better insight into the factors used by the regulators when they make their decisions, and for the regulators to have a better understanding of the impact that bank closures and consolidations have on our local communities and on civic and community organizations like our schools and faith-based institutions. We should also examine today the FDIC's flexibility in accounting for factors such as purchasing banks' knowledge of the market that it's moving into, as well as a bank's record of community investment and support beyond the standard CRA rating. If the FDIC requires a change in the current laws to be able to account for our community's well-being, then by all means we should have that discussion now before more and more banks fail and consumers suffer even more than they already have. Finally, I want to stress the importance of banks that focus on lending to our communities and not simply on using their money to make profits through trading on Wall Street. Real economic growth in this country happens when we invest in Main Street. It is based on old-fashioned lending through a loan to a bakery, to buy a new commercial oven, by helping to finance the expansion of a local school, by helping to put a child through college, or simply by offering them a reasonable, affordable loan to purchase a home. The economic crisis that we face was created by trading in confusing and all too crazy products like credit default swaps and mortgage-backed securities, not by financing the expansion of hardware stores down the street. This kind of trading is still based too much on greed. Just take a look at the decrease in lending last year and compare that to the increase in bonuses doled out by many of the largest and yet most vulnerable institutions. And as our local lenders close all around us, these banks continue to play financial roulette. It's fundamentally backwards and quite simply counterintuitive. I believe that in order to stabilize our financial system, we must re-examine what it means to be a successful bank in this country and encourage a return to fundamentals of lending. I'm glad to hear that President Obama will be addressing this very issue later today when he announces his plans for limiting the ability of commercial banks to conduct proprietary trading with their depository funds. Finally, I want to thank all of you who came to this hearing, in particular those who made the long journey by bus. I applaud your interest and your involvement in this important issue, which are vital to the sustainability of our communities, and I look forward to hearing the testimony of those before us today.